Managerial Accounting Example 5B, Part 3. Requirement 3 says prepare a performance report showing activity variances and revenue and spending variances for the year. So really what the activity or what the performance report is it's simply filling in the details of the columns, filling in differences in these columns. And I'm going to go ahead for the moment and hide these. We're not going to delete them, but we don't need them for the moment. So I'm going to go ahead and hide them. And I'm going to insert a few more columns here. And you'll see what I'm doing in a second. All right, so we've got three different columns here. Our original budget at 40,000 units, our flex budget at 43,000, and our actual results at 43,000. Between each of these, we have a difference. So the difference between a budgeted number and another number, whether it's another budget or an actual, the difference between something that was planned and something that's more actual than what was planned is going to be called some kind of a variance. Now, if we look at the difference between our flex budget and our master budget, the only difference here is that we had 40,000 units budgeted here and 43,000 units budgeted here. So all of the difference between these columns is because of the amount of sales activity. So the authors of the textbook that we're using for this section of the course, the Noreen Brewer Garrison book, they call this an activity variance. I also see it called a sales volume variance. Unfortunately, variances go by a variety of different names. So we do have to be a little bit careful when we're dealing with variances. We need to know exactly what variance we're talking about. And a variance, again, is simply a difference between two columns. So we can subtract one column from another. Now, I'm going to do everything in absolute value terms because what I don't want to do is deal with positives or negatives. So I'm going to do the absolute value of this column minus this column. And everything's going to be in absolute value terms. But absolute value doesn't quite tell us everything we need to know, because we have the idea that some things may be better than budgeted or some things may be worse than budgeted. And so what we do in variances is we're going to label a variance favorable if it improves net income or unfavorable if it decreases net income. So we can look at revenue. We've got a $75,000 increase in revenue between our master budget and our flex budget. That's because we sold more units. That's a good thing. That's going to be a favorable variance. We look at our variable costs. As a result of selling 3,000 extra units, all of our variable costs are higher at the flex budget level than at the master budget level. So we're going to call all of those unfavorable because an increase in variable cost will cause a decrease in net income. Now it feels a little bit backwards because we don't mind this increase in variable cost. It's actually a good thing that we have budgeted variable cost increasing because we're selling more units. However, the way the variance model works is any increase in expenses has a negative effect on net income. And so we're going to call that an unfavorable variance. Contribution margin is higher at the flex budget level than at the budget level, so we're going to call that favorable. All of our fixed overhead variances should not be anything at all because they're fixed. And so we go down to net income, and our net income should be $42,000 higher because we sold more units. So we're going to call that favorable. In this course, every variance is in dollars. Every variance that's not zero has an F or a U for favorable or unfavorable. That's how it's going to work. So that's the activity variance. And again, it's called an activity variance or a sales volume variance because all the numbers in this column depend entirely on the fact that we actually sold 43,000 units instead of 40. This column doesn't tell us anything about cost control or about revenue per unit. All this column tells us is what the natural effect of selling 3,000 more units should have been if all of our cost volume profit assumptions held. Now, here's where we have another problem. The other problem is the fact that all of our cost, volume, profit assumptions did not hold. And instead of making $1,075,000 of revenue, we only made $1,010,000. Instead of our variable costs being what they should have been, they were what they were. The same thing with our fixed cost. So we have to deal with the fact that flex budget didn't come true. The authors of the Noreen textbook call this the revenue and spending variances. I've also seen them called the flexible budget variances. So I'll give you both of these titles. And again, we need to be careful to know what variances are being talked about, because variances come in similar sounding names. Again, these are measured in dollars because they measure the effect on net income, and we're going to look at all of these and try to figure out whether they're an increase or decrease in net income. So in this case, our actual revenue was $64,000 less than budgeted, so we're going to call that an unfavorable variance. That decreases net income. Our direct material variance is going to be favorable because we actually spent $193 instead of the $215 we should have spent. Direct labor, we spent more than we should have. We're going to call that unfavorable. The variable overhead per cookie, we spent $68 instead of the $64.5 we thought we were going to spend. That's unfavorable. Sales commissions should have been $53,750. They were only $50,525. That's a favorable variance. It increases net income because it's a reduced expense. It probably has something to do with the fact that our revenue was lower per cookie. So total variable cost was $484 instead of $462. That's unfavorable. That's going to reduce net income. Total contribution margin should have been $612 at 43,000 units. It was only $525 at 43,000 units. That's going to reduce net income. That's unfavorable. Two of our fixed costs are higher than they should have been. Those are unfavorable. Two of them are the same as they should have been, so those have no variance. And then finally, our total fixed cost is $14,000 higher. And down at the bottom, at the net operating income level, we have an unfavorable variance of $101,075. So really what we're doing with our performance report is putting a number and an evaluation on all of the variances that we have calculated. I'll fill the formatting in there for you so it looks a little nicer. And we're putting we're putting the numbers and the evaluations on there so we know how to interpret these variances. We know whether something is good or bad. So that is requirement 3, a performance report showing activity variances, also known as sales volume variances, and revenue and spending variances, also known as flex budget variances.